Thanks for being here. We are pleased to have you join us for a conversation on employee ownership. My name is Elle, Kang, and I am one of the student leader for Corporations and Society Initiative this year. I am joined by my peer, Ryan Zepeda, another CASI student leader, who will kick off the Q&A later in the event. I'll first give you a brief introduction to CASI before introducing our guest for the event, Peter Stavros. Founded by the Stanford Graduate School of Business faculty, Anat Admati, and co-directed by Anat and Paul Flederer, the Corporations and Society Initiative is a faculty and student-led initiative that engages on issues at the intersection of markets, businesses, governments, and society to promote a more accountable capitalism and governance. CASI is known for its challenging engagement on the issues that are often overlooked and avoided, including conflicts of interest, power and information imbalances, corruption, and the abuse of entrusted power, aiming to uncover and impact narratives and their consequences. We are proud to announce today's event is co-sponsored by the Rock Center for Corporate Governance, a joint initiative between the Stanford Law School and Stanford Graduate School of Business. It was created to advance the understanding and practice of corporate governance in a cross-disciplinary environment where leading academics, business leaders, policymakers, practitioners, and regulators can meet and work together. Today, we are excited to host a robust discussion on both the advantages and disadvantages of extending employee ownership, as well as how to think about the optimal circumstances and structures of such a model. To do so, we are joined by our guest, Pete Stavros, co-head of global private equity at KKR, a leading alternatives investment firm with more than $500 billion in assets under management, and founder and chairman of the nonprofit Ownership Works, which seeks to create and implement broad-based ownership programs that promote wealth creation for low-income workers. As for the event structure, we'll start with a presentation by Pete before moving to Q&A. Please hold your questions until that time. For those watching on Zoom, feel free to put the questions in the chat. With that said, please help me give a warm welcome to Pete Stavros.
And I have no problem with questions along the way, so if you have a burning question, feel free to raise your hand. So maybe we could turn that down slightly. Thank you. I'm going to talk to you about broad-based ownership as a concept in business. As Ellie said, what's good about it, I wouldn't say there's disadvantages, but it's hard. As I'll explain, this is not an easy thing to pull off. This nonprofit, which initially my wife and I were just going to start, and it was going to be, it's still pretty small, but it was going to be just the two of us trying to spread the word on what had worked for me professionally, which was spreading ownership broadly with all employees in companies. And the Wall Street Journal wrote a story on a deal that I had led, and they just in passing at the end said, Pete and his wife are starting this nonprofit. And we got so many inbounds from people saying, if you're serious about this, we'd like to be a part of it. And as long as you acknowledge this is difficult, we'd like to go on the journey and see if we can figure this out. So as you'll see, we've got, this is actually an old graphic, but there's a lot more that have signed up now. We have almost 100 organizations ranging from every bank on Wall Street to Elle. McKinsey is a big part of this effort. But what's exciting is not just investors and Wall Street people, but we've got pension fund leaders, union leaders who are around the table with us, nonprofit foundations, many of whom are hugely critical of private equity and I would say skeptical of capitalism. So what excites me about it is we've got a lot of people from different perspectives actually working together trying to figure this out. So I will briefly explain the logic behind why we need this as a society. I'll talk through a case study and then I'll go a little deeper into this nonprofit. So just briefly, this is a very personal journey for me. My dad was an hourly construction worker in Chicago for over 40 years. That's actually a picture of my dad. He operated a road grader, he's a union guy. And growing up, the lessons around the dinner table were very much about what it was like to be an hourly worker. You don't have a voice. You think you have all the best ideas because you're doing the work. You're closest to the work, but nobody listens to you. You have no sense of alignment because if you're an hourly worker, what do you want? You want more hours and you want overtime hours and your employer wants exactly the opposite. So all the fights and all the strikes we lived through were around hours. And my dad always wanted profit sharing or ownership through his union, in part to align incentives, and of course also in part to have a chance to build wealth. Earning $15 an hour, it's hard to get ahead. So from that upbringing, I had a couple of random things happen. I ended up at an investment firm. My parents didn't go to college. I had no direction. I wandered out of college and ended up at a small investment firm. And they had me work on two things right away, which really, I think, then directed me further in this area of employee ownership. One was they had sold a company called Clark Schwabel. And in the old days, when you sold a business and you were dividing up proceeds, there's a funds flow transaction. We don't really do this anymore. But you'd basically stick a very junior person like myself in an office, and you would manually confirm wire transfers. And so I spent 2 days confirming wire transfers to executives at this company. And what struck me was you would confirm the wire transfer to the CEO, who would make millions of dollars, and it was very much a matter of fact. Yup, got it, click. When you got down to the assistant treasurer, the person was so overcome with emotion, they couldn't even get the words out to confirm the wire. So you sit there and you think, my God, what emotional energy is untapped in this company? What if everybody had ownership? What could that mean? The second thing they had me work on, which I'm not going to spend time on, I'm happy to talk afterwards because it's very complicated, but was an ESOP. It's a technical tax structure that was created in the 70s to encourage worker ownership. Basically, you could stop paying federal income taxes if you shared all of the common equity ownership with workers. It has unfortunately not panned out because the law was so poorly orchestrated, but that's something we could talk about afterwards if you'd like. And so then when I got into a leadership role at KKR 14 years ago, I started experimenting with non-ESOP ways of sharing ownership broadly. So getting into why is this important? The first one is obvious. There is a lack of wealth in the bottom of half of the country. There is no wealth. What's not so obvious to many people is the driver of it is stock ownership. There's a lot of talk about how home ownership will be the great leveler. Home ownership's not the problem. It's the ownership of appreciating assets in the form of stock. So the bottom half has 200 billion. This is Fed data. And the top 10% has 30 trillion. And what should concern you about this is that gap compounds, because equity values, even if the market doesn't do great over the next 30 years, that's going to be hundreds of trillions of dollars. So that's obviously not going to sustain itself. It cannot. Racial equity and gender equity is another opportunity with broad-based ownership. So, when I talk to leaders in the black community, they say, of course we want more black CEOs. But what you could do right now to help the black, Hispanic community and women in the workforce is share ownership with everybody. And until we get to that point where there's greater diversity in the C-suite, which is where all the ownership resides, so it's way overweight white men, it's where all the stock goes, it's where all the big wealth is created. What if you shared it with everyone? And I included, these are two actual companies that we bought. And if you were to look at aggregate EEOC data, you would have looked at these companies and said, wow, they're pretty diverse. But all the diversity was stacked at the bottom. And that's where ownership and wealth creation opportunity does not travel. So when you share ownership broadly, there's a big opportunity here from a racial equity and gender equity perspective. Employee engagement is an epidemic in the country. It's gotten worse since COVID. But 68% of Americans are not engaged on the job. This is Gallup data. Gallup is the 800-pound gorilla in employee engagement. 50% are not engaged, kind of like don't really care, don't love their job. 18% hate their company. They are actively disengaged. So these are people throwing the proverbial wrenches in the machines, trying to hurt the company that they work for because they hate it. So there's a big opportunity, not that stock ownership alone is going to do it, but there's a big opportunity to change the dynamics inside of a workplace. Financial literacy, another epidemic. 2/3 of Americans are financially illiterate. I've been doing work on financial literacy for a long time. It's very difficult. And one of the problems is that people won't engage on the training. So if you offer free financial counseling, and if you even pay for their time, often you will get 3 to 5% take-up rate. So it's free to them, you will pay their hourly wage, and they still won't show up. So we've done a lot of survey work on why this is, and the number one reason is, hey, I have no assets. I have nothing to talk about. I have a lot of debt. I know I have problems. I know my credit score is an issue. Why am I going to show up? There's no hope. We have found that if you share ownership, you can take that 3 to 5% to 50%. So this can really be a breakthrough way to get people engaged on their future and on understanding basic financial concepts. So this is another big issue in the economy I'm sure you all are familiar with. Maybe you aren't. Sometimes this shocks people. 40% of Americans quit their job every year. So 4 in 10 every single year decide to leave. So an average company is replacing the entirety of their workforce every 2.5 years. What a waste. What a waste for the company, what a waste of human talent. People aren't advancing their skills, they're just bouncing around trying to find something better. And the labor force participation rate reflects that, where people are increasingly just giving up and leaving the workforce. So again, not that stock ownership is going to fix all of our problems, but I think it could encourage people to get off the bench and say, I'm going to re-enter the workforce, and maybe I'll stay at my job and try and build some skills in advance. I want to be really clear on what we mean by employee ownership. So employee ownership, in our definition, is not you hand out some stock and hope good things happen. It's you hand out stock and you go through the full program. So you teach financial literacy as a foundation. You share information transparently, how decisions are made, how much money the company makes, how we make money, how what you do every day ties into our value creation program. We give you data on how you are doing and your shift. If you're working in a manufacturing plant and the goal is scrap, you'll know how your shift, your line is doing every day. Implementing worker voice initiatives. This is a massively overused term, worker voice. And I'm not saying we're great at it, but we're trying. Giving people more control over their work. We leverage a lot of Toyota production system concepts around Kaizen, where frontline workers get opportunities to help redesign their work. And then we do more programmatic things where we will turn over a portion of our capital expenditure budget, for example, over to the workers, and they'll decide how to invest it. So I also want to note two things about the equity itself. Number one, it's got to be a meaningful amount of money. If you're going to ask people to change their behavior and go on this journey, they need to see a path, ideally to making a year's worth of their income. But for sure, less than 6 months, don't bother. Sometimes CEOs say, hey, I'd love to give everybody $500 a stock. That's a waste of time, and it's not worth the effort. Find another way. The other thing I want to make clear is this is not being purchased by workers. So it's not being purchased. If you make less than $100,000, we don't allow it, an investment in the company, and it's not a trade for wages or benefits or wage increases. This is not about shifting risk onto workers. This is an incremental free benefit for workers that we earn a return on through culture and dropping the quit rate. So I just want to give you one quick snapshot of a case study, and then I'll talk you through one in more detail. So this is a company that we bought. It was a public company, and it was a mess. There were 86 people who had ownership in the company, all stacked at the top. The quit rate at the time was high. 20% is not bad anymore. And it was kind of a rudderless ship. The leadership was terrible. The turnover at the top was quite high. We brought in a new leadership team, and I won't take you through everything that they did, but over the course, this took 10 years. So this has not happened overnight, but over the course of 10 years, 16,000 people in 80 countries were made owners. That wealth creation for workers was $800 million. So it's the largest such example of this ever. The quit rate dropped almost 90%. So we were hiring 3,000 fewer people every year as a result of all these efforts. And the engagement survey results went from the 20th percentile to the 90th. So you can imagine the impact on our ability to execute on value creation initiatives when you've got people more likely to stay who are engaged on the job and feel like, hey, I have a stake in the outcome. There's a reason for me to be here. So this case study I'll go into in a little bit more detail. This is a company that we acquired that was kind of the Ingersoll Rand story. It was disengaged workforce, lots of turnover, low engagement even at the senior levels of the organization. And it had been owned by private equity 3 times before we bought it. So there was definitely a question of what in the world, first of all, it's a garage door company. Why are you going to buy a garage door company? And what could you possibly do as the 4th investment firm over the last 20 years? So the company, I'll just jump into this is what we found when we showed up. So there were 800 employees. The light blue dots at the top are hourly employees in the plant. 54 truck drivers who were paid by the mile. It's kind of like being paid by the hour. You don't have much of an incentive, just however many miles you drive. The purple dots were office workers without ownership, and then 18 people had stock ownership in the company. So 18 out of 800, it's about 2%, which is usually what we see, anywhere from 1 to 3% had stock ownership. 18 people got a payout of about $60 million, and most of it went to 2 people. So, and this is a microcosm of corporate America. This is how most companies look. So with that setup, you wonder what morale looks like. One thing in addition to look at, when you're wondering about morale, and I wish this was these stats were more easily accessible for public companies or for investors looking at public companies, but the safety record. So is the company care enough to even make sure people are getting home safe at night after work? So you can see this is called total recordable incident rate. Think of it, it's injuries per 200,000 hours of work. It's roughly equal to the percent of employees who are getting injured on the job every year. So 14 meant 14 out of every 100 every year with a serious injury on the job. So over 5 years, that'd be most of the workforce, unless it's the same 14 people getting hurt. That was triple the OSHA benchmark. So a massive failure on the part of the company. So we did our first ever employee engagement survey. The results were terrible. 30% bothered to respond. 90% of results were well below benchmark. And then my favorite question, most people said the survey would have no impact because nobody's going to listen to what we have to say. So that low level of engagement, and this was, when you go back to why would you buy a company that had been owned by private equity 3 times before, this had never been tried to engage with the workforce to fix some of these problems. So the lack of engagement reflected itself in quality issues. By the way, if you have a quality issue in a plant, you're always going to have a safety problem because they both reflect the quality of your process. So there were quality issues, safety issues, way too much inventory. It was a build to order model. They were making garage doors to order, and yet there was a ton of inventory all over the plant because people just didn't care. And there was no margin growth despite pretty good volume growth. Housing was recovering at this time. And as I mentioned, very poor process control. So we brought in a new leadership team, had a whole new set of priorities, really re-energized this process orientation that every good manufacturer should have, and then we rolled out this model. This at the time was the 6th time we had shared ownership with everyone and really rolled this broader program out. So everyone became an owner, and then this is where the hard work comes in. So educating people on basic financial concepts. You start with literally what is equity? What are we even talking about? Getting into how are we going to create equity value once you understand equity. And it's, okay, there's a big opportunity, let's say in scrap. And then we take that big picture goal, break it down by plant, by shift, by line, and then it's all about giving people data. The number one reason, according to academic research, that workers are not engaged on the job is they don't know how they're doing. So the performance evaluation system stinks. They get no input. They go home to their spouse. How was your day? No idea. I don't know how we did. And we try and turn that around, and I know exactly how we did. We lost today. We had a scrap goal. We didn't hit it. And then we try and gamify some of it. So you hit your scrap goal for a week, we'll buy your lunch the next week. All these kinds of things that we're driving improvement, and we're tying it again, not only to long-term equity value creation, but short-term goals where people can get rewarded. So sharing information, soliciting input, we do some things that would sound stupid to all of you in this room, which is printing physical stock certificates. A lot of people have never owned stock, so that physical manifestation of ownership can really make a difference. And of course, paying an early dividend. Nothing like cash in the door to have people see this is real ownership. So we went from these results I showed you earlier, 30% response rate, 90% below benchmark. In 3 years, this isn't like amazing. This is not exactly a certified great place to work yet, but 80% of people caring enough to respond, and now we're 50% above benchmark. And it's hard when the response rate goes up because your results go down. So once people actually start speaking up, you get worse scores. So you kind of have to come out of this valley, which the leadership team was able to do. So on education, I kind of touched on this. There's 2 parts to it. There's the personal financial literacy training. Here we partnered with a nonprofit called Operation Hope. You might recognize this guy, John Bryant. He's always on CNBC. But his nonprofit teaches basic financial skills. So we brought John in and basically did workshops with people. And then for people who wanted to opt in, we had a full-time coach at the plants all the time, 5 days a week. And they're willing to work with you and your family. And then the corporate financial education, this is, again, what is equity? How are we going to create value? How does what you're doing every day matter? Worker voice, this is just one example. I kind of referenced this earlier. We experiment with this concept all the time. How can we get people's voice amplified in the business? This example was just trying, what if we took $1 million a year per plant and we said to the workers, you guys invest it however you want. Whatever you vote for, We'll help you sort through ideas, we'll set up steering committees, and you present to one another, and whatever you vote for is what we'll invest in. So the first thing they wanted was air conditioning. So it might surprise you, most manufacturing plants are not air conditioned, and this is in central Illinois. Got to be over 100 degrees in the plant in the summer, which is our busiest time. People were getting exhausted, and when you're exhausted, not only do you make quality mistakes, but you get hurt. Those are when people get hurt. Then they wanted a cafeteria with healthy food options, because this plant was in the middle of nowhere, and they said, the only thing I can do is like go to Subway, I'd like healthier options, so we built an on-site cafeteria. For similar reasons, they wanted an on-site medical clinic, which was plants in the middle of nowhere, it takes too long to drive if I just need a simple prescription, so we have an on-site medical clinic now. They wanted new break rooms, and so all of that, the cumulative impact of that is big. We would have open forums for their families to come in and see what was going on in the plant, and people would show and say, these break rooms, this is my idea, or I was on the steering committee that studied this. The other thing I would say that was interesting, which I'm embarrassed to say I did not notice until this woman, I was doing an interview with this woman from NPR. She said, do you ever notice this is all wellness related? Like when you they could have spent the money on anything. They could have said, I want more, I don't know, put a movie theater. You said you'd do anything, build a movie theater here. It's interesting that people start feeling differently about the way they're treated, and her theory is they start valuing themselves differently and start putting a greater emphasis on wellness, which I think is an interesting idea that we're going to study more. What's also interesting about these investments is, none of this stuff at the front end has an ROI attached to it, but it all comes back to the company anyway, even though it's not the reason you do it. If you look at this, this is showing incomplete deliveries. So when you deliver a garage door is not just a garage door. It's springs and a remote control and all these little component pieces to hang the door. And so what happened was, we didn't even realize this, the summer months when people were so tired and exhausted because it was so hot in the plant, they were making a lot of careless mistakes. So this shows you basically the year before and after the air conditioning. So imagine how much market share we gained right there. Because think about a customer, how painful it is. You're expecting your garage door to be hung that day, and the garage door installer, who's our customer, drives all the way to your house, opens up the package, and is like, oh crap, they forgot a spring. So it's not why we did it, but all of these things, I would argue, they ended up all paying for themselves. So back to the Toyota production system, if you're going to be involved in a business, you've got to, did you guys study TPS here at all? Was that okay, so go to Gemba. If you're familiar with that, you've got to go to where value is created. You got to go see it with your own eyes. We are big believers in this. So this is kind of a silly illustration of me and this truck driver, Larry, going on a ride along, this is what we do with salespeople. We work in plants, we ride with truck drivers, and you're learning as you're working with these folks. And this is an example. So he was so excited to show me, now that he was an owner of the company, how stupid his route was. And he wanted to show me that at the end of the route, this was, we drive around Wisconsin here, but at the end of the route, you'll see we go all the way to northern Michigan to deliver one door. And so Larry had pulled the catalog, done the math, and said, I know what you pay me per mile of drive time, and there's a flat fee per delivery, and I know what doors sell for. There's no way this can be profitable. And his math wasn't perfect, but it was close enough. And sure enough, we were making no money. And so what was happening, we had a very sophisticated route scheduling system in our route scheduling department that was being overridden by our route schedulers trying to do good. They wanted to make small customers and small deliveries. They say, hey, this is great customer service, but it was costing us a fortune. And so this is the kind of thing that you can't figure out in a boardroom. You really can only figure out if you're in the field. And it's, by the way, a lot easier if you've got engaged employees who care to speak up. So these are just some of the results. Big improvements in engagement scores. If you look at safety, not all the way where we want it to be, but huge improvements. And then this owner's mindset kind of developing over time where people are speaking up and helping us drive change in the business. This is one of our favorite slides to show our investors. So for those who are financially inclined, this is the basis points of change in the EBITDA margin over time. So as I said, this has been owned by private equity for 20 years. The EBITDA margins were good, actually really good. For a building products company, this had 21% EBITDA margins, which would have been top quartile for sure. But the dotted line shows this new model, the implementation, and the profit margins, EBITDA margins went from 21 to 36. So 36% EBITDA margins for a company making garage doors, people would have said, absolutely impossible. It's like a software company. And by the way, you're the fourth private equity owner to own it. It's not possible. But this was this cumulative impact of all of these little things over 8 years that made that possible. So this is the kind of jumping now to the end of the story in the case study. This is in the main plant in Arthur, Illinois, when we announced the sale, and we can get into the mechanics of how we do the ownership, but basically different parts of the company had pools of ownership that become crystallized into value when we sell or when we pay a dividend. So this was the crystallization, like the big crystallization at the end of the 8-year journey, and so this is everyone learning about what this meant for them.
Imagine you wake up on a random Wednesday in the middle of your life, and everything that you've ever wanted to do in your life, you can do now. All because you came to work and you did things the right way, and someone held up their word to you.
All right, this is a little different than when we normally get together. Anybody want to have an owners meeting?
We do have some news to share, and the news is we found a new owner for the business.
Pete Stavros is here. He's the co-head of the private equity firm KKR.
I mean, the performance of the company and the growth in value was astonishing. This is beyond our wildest dreams in terms of how well this business performed. It is a huge collection of lots of little things that the workforce did. Again, they did it. They earned it. Made this company more than triple, almost 4x their profits. And so shouldn't everyone participate? That's the simple philosophy.
So, logical question would be, what does this mean for you financially? Because you're all owners in this business. You guys ready to get into it? Yeah! Even our newest colleagues are going to get a meaningful payout of $20,000. Well, if you think that was good, hold on to your hats. If you joined last year, the payout is $40,000. So for this cohort, the payout is 1.5 times annual pay. So the average payout is $70,000 for this group.
I was shocked. I was standing next to my nephew who just started. I remember looking at him and hugging him and
This is 2.5 times your annual pay. 3.5 times, 4.5 times, 5.5 times your annual pay. For this last group, the payout is 6.5 times.
It's truly emotional. Like, I've never seen anything like it in my life.
The excitement, the tears, the goosebumps, the just sheer excitement. Everybody was in shock, honestly.
First thing is, we're prepaying for financial coaching for everyone. We want to make sure that you guys understand your payout, understand your tax situation, you know how to invest the money, and it gets put to the best use possible.
Still can't believe it. I mean, but it's good to know that you work for a good company and put your time in. They do help you out as well.
Where else have you seen this many men and women hugging, shaking, crying, you know, sharing stories of how we started out here, what we do every day coming into this company to try to make it better for everybody.
It brings that extra oomph to every person that works, knowing that they're owners. Workmanship, you see everything's gone up. Just other companies need to do this.
Every cent that we get back, we earned.
I've never had anything like this happen to me in my entire life. This is life-changing for everything.
I wish that every company could see what this has done.
Every dream that I've ever had in my life, I can do now. It doesn't just change my life. It's going to change the whole community.
And obviously they aren't always that good. That was an exceptional outcome. More often it's, 100% to 200% of income, so it's a lot, but not that level. Okay, I'm just going to close, and then we can chat on Ownership Works, just tell you a little bit more about it. There's 2 points to Ownership Works. One is to provide hands-on practical resources to companies who want to roll this model out, because it is very hard. It sounds easy and elegant, like you give ownership and all these good things happen. This is so difficult. And it doesn't always work, by the way, despite your best intentions. And then the second part's to build a movement, all with trying to get, our real goal is 100 billion of wealth over 15 years, but people smarter than me said to lower the number and shorten the time frame. On the hands-on practical resource, we're organized into 3 verticals. How to structure and implement these programs. So how do you size these grants, vesting, retention requirements, what if the company goes public, all these kinds of things. And as you can see, we have partnerships with Deloitte, EY, McKinsey, and others who help us there. Engagement and worker voice, I really should have McKinsey here. They are probably the biggest force in Ownership Works on this employee engagement effort. They must have done $20 million of free work for us by now. And they're basically building out a content library of, if you're a CEO and you want to do this, like, where do you start from an engagement perspective? How do you build this ownership culture? And then financial inclusion and resilience, this is about financial literacy training, and we've got a bunch of great partners there as well. On the movement building, these are all the things that we're focused on. Videography and storytelling is the biggest one. Just having people see videos like that. That's our biggest source of inbound interest, is people saying, hey, I saw, the Harley Davidson CEO called and said, I saw a video, I want to do this for my employees. Setting standards, so we, if we're going to build a movement, we got to be very careful with this model. We wouldn't want, for example, a company to have lower income workers invest out of pocket or ask people to trade wages for stock. So we do have standards, people sign contracts who work with us. Best practice sharing, as an example of that, is next month at Ford Foundation. We have 100 CEOs coming together to do just that. So there's going to be workshops, and it's basically building a network of people who want to work on this data analysis and research, of course, trying to prove the impact, both to business and workers, and then lastly, policy. So I'll skip this, but this is just an example of a bunch of the inbounds we get. The CEO of Harley called and said, can you help me roll this out? He was brought in to turn around the company, and the union absolutely hated management. So this was turning over a new leaf. So I won't bore you with all of that. But this is kind of covered this. We've got a brilliant woman, Annalisa Miller, who runs Ownership Works. She's got a staff of about 25. We'll probably top out at 35. And we've been fortunate to raise a bunch of money. So what I didn't want was sometimes nonprofits start and then they hire a bunch of fundraising people. And so I didn't want that. So all of the sponsors I had signed 5-year commitments. So we've got a bunch of years of runway. For those of you who are familiar with the nonprofit world, the term of art is theory of change. Like, how are you going to change the market? How is this ever going to happen? And it's the old-fashioned domino effect, which I laugh saying, but I think this actually is going to work, which is you get enough early adopters, they're telling stories about what's happening, the LPs come on board, that meaning the investors in private equity funds come on board, and then trying to do the same thing in the public markets. Private equity, for all of its issues, one very positive aspect is it's such an efficient decision-making apparatus. It's such an efficient governance system. So I could go try and convince all the Harley-Davidson type CEOs to do this. I had to present to Harley's board multiple times. I mean, it was a lot of work. It took 9 months, and we impacted 4,000 people, which was great. Or I could convince the CEO of a private equity firm that owns 100 companies, and it's 500,000 people. And so, again, for all of its issues, if we could get private equity to lead here, you could have the numbers, aggregate massively. At our firm, we have almost 1 million employees alone. So, keeping perspective, this is not going to solve all of our problems. The economy is not working for most people. This is tweaking a system that is broken. In fact, you could take the flip side and you can say, isn't this just like shareholderism again? Like, you guys made more money. So it's part of what I don't like talking about is having to prove the business case, which you have to do because we're fiduciaries. It's not our, we just can't be like, everybody gets stock. Who cares if it has an impact? But it does not feel great to be like, if we give poor people just a little bit of ownership, like we could grind this thing even tighter and get more scrap out and more productivity and more inventory out and we make more money. So, that's the world we live in. We got to prove the business case, but it's frustrating that it's not just taken on faith that this is the right thing to do. I also want to note it is uncertain value to employees. This is not a guaranteed retirement. This is risk. This is ownership. So although they're not risking anything, I shouldn't say it's risk. It's just uncertain upside. That's probably the better way to say it. And then what happens when we sell the company? We exit companies three ways. We sell to a big corporate, we sell to another private equity firm, or we take the company public. The last two are easy. If we take the company public, this model lives forever. Like Ingersoll Rand will be employee-owned forever. If we sell to another private equity firm, that's easy, because you'd have to be brain dead as an investor to tear down that culture. No one's going to do that. The tough one is when you sell to a big corporate, because they say, okay, I bought CHI Overhead Doors, you have like 1,000 people, I have 400,000 employees, I can't turn my comp and benefits philosophy upside down for what you did here. So that is the toughest nut to crack, which I don't have the answer to. So that's it. Thank you for listening. I'm happy to take any questions.
Pete, moving into the first question, we talked a lot about the benefits of stock ownership and employee options, especially for private-owned companies in the PE context. I'd like to expand our aperture to applying this practice in public companies or in other industries, specifically to hear your reaction on some of the potential drawbacks, some of which I think you alluded to in your program design, but I'd like to touch head on. So bear with me for this vignette. So let's say an employee was to receive $10,000 in her public employer stock in lieu of $10,000 in cash compensation.
That would be the first violation, so I'm happy to talk about it, but
we'll get there. So assuming the employee must hold the stock and cannot sell it, it would appear this employee is worse off financially. This is due to three reasons. One, employees with cash compensation already always have the opportunity to buy the employer's stock if they prefer. Two, the $10,000 would likely be better invested in a well-diversified index fund than concentrated risk in their employer. And three, illiquid equity and options may be inconvenient or unhelpful in meeting their day-to-day needs. How can a manager ensure that any compensation requiring the employee to hold the employer stock is truly additive and does not reduce their welfare by trading off other forms of compensation that are maybe more desirable? How can we ensure the amount of equity distributed appropriately compensates employees for their relative value created?
So I'm not going to address the heart of the question because we would never work with a company that was going to trade off wages for stock. But I think an interesting question is, which is kind of one of the things you're getting at is, isn't it just better to give cash? Like, why give stock? Why don't you just give them a bunch of cash? And CEOs will say that to me, and I'll say, that's awesome. Let's do that. And they're like, I can't just do that. We'll take the earnings of the business down. Our fixed costs will go up. So the volatility of our earnings stream will go down. With our margins down, the valuation multiple's lower. It's like, okay, so what are we talking about? That's not a practical solution. It'd be great if it were. If people would just say, to hell with it, we're going to triple everyone's wages. And to replicate the amount of upside we're talking about through wages is not possible. You can't take wages up to the point of giving people hundreds. It's just not feasible. So, but that is a question that comes up a lot. And if you think about from the employee and the employer perspective, so from an employee perspective, I think positive would be more cash, they have needs today. That'd be great. Negative is you can't replicate the kind of wealth we're talking about. From an employer perspective, stock aligns interests. So that hourly wage thing my dad dealt with, stock would help to mitigate to some extent that problem. And then the last part, I think is the hardest one, which is how do you know you're giving workers a fair share? This is a step in the right direction. This is not solving the world's problems, but this is better than the alternative. Because we're fiduciaries, we can't give unlimited amounts of stock out. So there's a pool we have to manage. We have to recruit great people at the top. So some of the equity pool has to go to the top. How much then goes to everyone else is the question. Here it ended up being about 5% of the upside. And it ended up being, I forget the numbers now, but hundreds of millions of dollars. So, should that have been $1 billion or, what the right number is, I don't know how you'd ever measure it. We look at it on an individual basis. We think at least a year's income is meaningful. Hopefully it's more than that, but that's kind of below that, we wouldn't bother.
Thank you. And then one more question before we open it up to the room. How does this translate to other industries? Your team started with a focus on industrials and it seems has still mostly used that model in that particular industry. I'd imagine that that might look different for a different business in terms of how you engage employees and think about structuring kind of the incentives and aligning them. What would this look like for people in this room that may or may not be working in industrials? What would they have to think about?
So I used to run the industrials group, which is why this started there. So we started it with 12 industrial companies, but we've now done it 31 times. And other than the 12, the others are media, software, healthcare, financial institutions companies. So we've done it now everywhere. I would say industrials, the positive, this is a weird way to say it, the upside is workers hate their company. So 80%, an industrial company, 80% are hourly workers, they hate the company, they're super disengaged. So there's humongous upside. The hard thing about industrials is folks often start with a low level of financial understanding. So it's a tougher hill to climb to get people to really understand and value and engage in this way. And it's often a global, very dispersed workforce. So Ingersoll Rand, 80 countries, hundreds of facilities. So you just think about the amount of complexity there and how heavy of a lift it is. So lots of upside, but wow, is it hard. Software, I'd say, is the opposite, the other end of the spectrum. Very financially sophisticated folks already have pretty high levels of engagement, but it's super easy to implement it. There's usually a pretty consolidated workforce, not that many people, and as I said, they're pretty financially sophisticated. So I feel it as kind of like there's a trade-off. Yeah.
Hi, Pete. Thanks for speaking to us today. Two more technical questions here. One is, do the shares actually then vest within those private companies? And second, what if an employee who is an owner then also leaves the company? Does he get to keep the shares? Does he have to sell them right away? If he keeps them, I can imagine that there's like some undesirable second round effects.
Yeah, so if you leave, you lose it. It's basically the same cliff vested equity concept that senior people have. What workers have that's better is there's no performance. So CEOs have to hit certain targets. Workers just, as long as they're there, they get it. If you pass away or become disabled, that's different. So that's very different from quitting or, in CHI, there were people who got cancer, long COVID, all sorts of things happened, and all of those people got cashed out.
Yeah, it's very interesting. I think you mentioned in the beginning that you have a lot of folks on board who are maybe skeptical of the role of private equity and all of this. And so I'm curious, when you're wearing your hat of pitching, how do you pitch this to the kind of large cap PE funds of the world? What's the hat that you wear? And then what is the hat that you wear when you're pitching it to a Midyar or Ford? And how do you kind of think about the messaging for those very, very different audiences?
Yeah, great question. So once I sensed there was real interest in this, the first two groups that I really wanted to engage with and sought out were Ford and Midyar. So Ford and Midyar back there's groups called PE Stakeholder Project. There's a bunch of PE watchdog groups that are very tied in with Elizabeth Warren and bring all sorts of actions against the industry. So I wanted them on board first. So I said, take as much time as you need. You could go walk our plants, you can study it for yourself, but if you come away thinking this is real, I want you to make a big commitment and be vocally supportive. So Darren Walker, who runs Ford, is one of our most vocal supporters. He's actually headlining the CEO convening. To that audience, it's all about the impact. So what Ford and Midyar told me was, we don't see new nonprofits that say we could create $100 billion of wealth for working families. That doesn't exist. So the magnitude of the impact was what kind of knocked their socks off and got them excited about it. And then to private equity firms, I would say it's very difficult because some are doing it because of the business case, and some are doing it because they think it's the right thing to do. And so you kind of have to get to know them and understand where they're coming from. And what I would say as just a digression is, and we could talk more about this if we want to talk about leadership and where this works. My experience is it does not work very well when it's about the business case. So, when this really works well, it's a CEO who says, I want to do this. I'll figure out how to make the company stronger and you'll make money. Don't worry about it. I want to do this because I've been a CEO for all these years and I've never really taken care of my people, and this is this is my shot to fix a lot of that. And I've been kind of complicit in the system where people at the bottom have gotten nowhere. That is the one. Those are the people you want, both in the private equity world and as leaders. So that I'll give you an example of this company we just bought. It's called Groundworks, and the guy who runs the company, Groundworks fixes damaged foundations in homes. So if you have water damage in your house, foundation gets cracked, they come in and fix it. So I always ask CEOs, hey, what's the point of Groundworks? What's the mission? Why are you so excited? Why do you jump out of bed at 4 a.m. to build the business? And normally the best you can hope for is the CEO to say, to give you like a very elevated sounding customer value proposition. So to say, God, our mission, it's so important. We're helping people stay in their homes longer, at the lowest cost possible, and safely. Like, that's an important mission, that's a pretty good answer. What's a great answer is what this guy said, which was, there's only one reason we exist. It's to elevate tradespeople. Only reason. That is the guy or gal you want to bet on. Those are people who almost as an adjacency make tons of money. It's really bizarre, but like this guy's culture, they take so much market share from all their competition. And it's the culture, it's the people, it's how he cares about his people, as opposed to the CEO who's like, yeah, if I can get the quit rate down 5 points and I can get we can make some money out of this, I can see it, we should do this. It just doesn't work.
Yeah, so to your point about being a fiduciary as a private equity investor, how do you quantify the impact of something that is relatively uncertain? And do you usually include that in your base case underwriting?
We include in the underwriting, let me try and answer it this way. So to your point, as fiduciaries, we cannot just like willy-nilly spend money unless we think it's a good investment. So the key is to get real clear about the cost. So what if we do this, and it's always hard to say how much of productivity is because of what you've done for workers, but what if there's no benefit? If you follow me, you get to the same EBITDA and earnings profile, and there was no. So then, if you run the math on 4 or 5 points of options over a 5-7 year period, it's a rounding error. It's like 1% of EBITDA. It's 30 basis points of net returns. So we start from a point of, to our investors, first of all, we're transparent. We're doing this. So if you don't like it, we may not be the right firm for you. But here's the math of it. If we're dead wrong, this is the cost. Are you willing? Do you trust us enough to make this bet and try and make a go of this? And of course, the answer is yes. I mean, these folks trust us with picking what company to buy in the first place. At what price? Of course, they're going to trust us with this incentive plan.
I had a question on the upper management within the company. So it sounds like, you discussed that there are companies who opt into this and they want to have the process, and then there's also the option of kind of these private equity firms that, potentially have this top-down directive to create this sort of process. Do you get any pushback from the upper management who might kind of have dilutive effects of their pool? And how do you bring them on board to be aligned with this sort of?
So I'll tell you what we used to do, which was we used to. So let's say the management equity plan, the option plan for all the workforce is going to be 12.5%. So what I would do is I would go to, and let's say it was going to be 2.5% for the workers. It all depends on how many people there are and their income levels and everything, but let's just say it was 2.5%. I would go negotiate the 10% with the team. So you, the CEO, you're getting 3%, CFO's getting 1.5, COO's getting 75 basis points, and then next level down, et cetera, and that's 10%. And I'd say, you guys happy? And they'd say, that's a fair deal. Great, here's 2.5% more. It has nothing to do with your deal. And this is for everyone else. We don't really do that anymore. Now it's kind of like if someone doesn't want to do this, we don't want to work with them. We've found a high correlation between bad leaders and people who don't want to do this.
If you think about the theory of change for ownership works, what's the barrier to your inflection point, or kind of the tipping point of making this even bigger? Is it time, proving out, knowledge, buy-in on some level? Like, what's the thing in the way for you?
So the biggest barrier is that CEOs are drowning. So when you raise this with a CEO, and I have empathy for this reaction, people will say, okay, Pete, my God. So let me just fully catalog what you want me to do in the next 5 years. Double my earnings. You want me to decarbonize. You want me to lessen our utilization of water, waste, energy, landfill. You want less landfill tonnage. You want the C-suite. You want diversity added. You want us to change the way we recruit so we're bringing diversity through the organization. You want a diverse board, and on and on and on. You want the financials by the 12th of the month, the metrics package by the 15th of the month. And now you want employee engagement, worker ownership, financial literacy training. So what are you tell me, what do you want? I can't do it all. And that is the biggest barrier. The unlock is convincing people of the business case, and that if you do those last three things well, all the other things that come before it are easier. Because you're not spending, for example, all the time and energy and money hiring 3,000 people a year who just walk out in 6 months.
So these case studies are amazing, and at the same time, obviously, as a giant PE firm, you guys are doing all kinds of value add, operational expertise, the employee-directed investments. So to your point on the challenges of attributing that productivity, have you been able to see, maybe anecdotally or in data with some other companies that are doing a more pure play? Okay, it's like no.
No, it's the right question. What I think we're going to be able to prove out is that with this model, quit rates go down and engagement scores go up. I can't say I've spoken to a ton of Stanford people, but I've spoken to MIT, Harvard, Chicago, Columbia, so many, INSEAD. How would we prove beyond a shadow of a doubt that then is translating to productivity? And the things that they come back with, our CEOs will never do. It's like, okay, well, here's what we'll do. I don't even remember the ideas, but within a plant, these lines will have ownership and these lines won't, and we stop at quit rates and engagement. And then we really clearly quantify the cost. And then we're transparent with investors.
So when we talk about engagement, what exactly are we talking about? I mean, what key metrics do you use?
So for us, engagement, the gold standard from an academic perspective, it's a measured employee engagement survey. The most studied survey in the world is the Gallup Q12, it's called. And then we've developed something called the OW10, which measures kind of ownership culture. So that's the gold standard around engagement, and then quit rate. Those are the two key metrics.
So this is a problem that's near and dear to my heart as someone who worked in a startup for many years and watched many of my coworkers unable to afford the equity that they were supposedly given as compensation. My question for you is, when I pushed back on this system and said, like, why are you giving ISOs? Why don't you give RSUs and just hand the value over? The argument I always got from senior management was, oh, well, then the employees would have to pay so many taxes on that transferred value. So in this model, do you cover taxes for employees after giving them ownership? Because would that imply that they would have to pay something on the value given to them, just like any income?
Yeah, and it's way more complicated in Western Europe and way more punitive. So this model, and this gets into the mechanics of it, and I'm embarrassed to tell you how many years it took me to come up with this. It's basically a pool of equity that's put into an LLC, that it's an irrevocable grant by the board, and the employees participate through that vehicle. So the good thing is, from a tax, legal, accounting, compliance, there's so many things you avoid. The bad thing is, it's more complicated to explain. Because once you get people to understand equity and equity value and all the rest, it's like, well, you kind of have cliff vested equity and it's in this pool. So it's more complicated to communicate, but I don't have a better way of doing it.
When the leadership's not on board, it doesn't work at all. What other, you mentioned a couple times that it's great when it works, there are times when it doesn't work. When are those other times, or when?
Yeah, I mean, it doesn't work when, well, and let me define what does it mean to not work. What it means to not work is, from a company perspective, engagement scores go sideways and quit rates don't improve. So you hand out this equity, you bear the cost as a company, the leadership team is supposedly putting all this effort in and the results don't arrive. So that would be one category of it not working, and that comes down to leadership. The leadership team has to literally live this every day. Like, they wake up and it's about, how do I engage my people? And they are hiring people whose only job is to work direct to the CEO on engagement programs. So that is one version of it not working. The other version of it is the company falls apart. So we bought a company in January of 2020 that made aerospace components right before COVID. A big announcement, everyone's an owner, isn't this going to be amazing? All this training, and then COVID hits and the market absolutely implodes. So there, if it's, the way we manage that is, well, what do you do for the leadership team? You reprice all their stock, because if you don't, they're going to quit. So our philosophy is, that's great, whatever you do for the leaders, you have to do for everyone else. So all the workers had their stock repriced to like 30 cents on the dollar. And by the way, now it's all recovered. So it was ended up being just fine for them, but those are the two versions of it not working.
Are there equivalent organizations focused on new start small businesses? I'm thinking in like construction or other industries with a really long tail where there's a lot less sophistication, but an opportunity to impact people's lives in that smaller organization construct.
So in the small, and I'm happy to talk more about this after, on the small business side, it is, I don't want to say most commonly, but it is often in an ESOP structure. So I'll try not to bore you to death with this. But in an ESOP, if you share all the common equity ownership with workers, the company pays no taxes. And the family that converted, if it's a two-legged shareholder, not a corporate shareholder, if it's a family selling it, the family can avoid paying any capital gains taxes. So if you just think about that for a second, holy cow, are those huge incentives. The family can pay no capital gains and the company pays no taxes going forward forever. So why is this not taken off? And that's what I wrote my paper about when I was in business school 20-some years ago. And I have a, this is a 501c3, there's a 501c4 I have that's going to try and fix some of these problems. Because small businesses have most often opted for that ESOP structure. I could tell you more about it after if you want. Yeah.
So let me introduce myself. I'm Joe Grundfest. I'm a professor at the law school. Present purposes, more relevant, I'm chair of the audit committee at KKR. All right, so people say, what do you do? It's really simple. My job is to make sure nobody goes to jail for too long. So I just want to reinforce a couple of things. First, the extent to which the entire organization is behind what Pete is doing and creating wealth sharing for employees is 1,000%. This is what we want to do. We want to do more deals like this for a variety of reasons. Second, we're all over-intellectualizing this. There's a much simpler way to explain why organizations like the Ford Foundation and other capitalists who just want to maximize returns will hold hands on these deals. And the answer is, it works. Think about it in the simplest possible form. If you give a 2.5% equity participation to the employees are sufficiently motivated that they create EBITDA that with the multiple is worth more than 2.5%. End of story. This is 2.5% of equity participation that the truck driver will never get anywhere else in their lives. And it's a multiple on the 2.5% that Pete is able to look at and say, you know, I'm going to take that risk. I'm going to get that return. You're all taught win-win. This is win-win. Right? The job is to find the situations where that 2.5% winds up leading to an extra $100 million for KKR and $100 million for the employees. The employees want that, we want that. Part of the secret sauce, finding management that believes in it where we don't have to persuade them that that's the case. The foundation company that Pete was just talking about, Groundworks, I love that deal for the following reason primarily. A large reason why we won that deal is the CEO wanted to have continued worker participation. Is that right, Pete?
Yeah.
All right? If we didn't come in and say, look, this is what we want to do, I don't know if we would have won that deal. All right? The CEO already had a level of worker participation, and Pete came in and said, well, that's not enough. We got to give your workers more. All right? And he thought he was going to have to fight with the PE firms, and you know, the PE firms want to cut back. Pete walks in and goes, no, you're being too chintzy. You're not giving them enough money. Goes, okay, I love this guy. We'll deal with him. So that's part of the future, all right, that we see sitting at the boardroom level at KKR, and we talk about Pete and we talk about everything that's going on. We're all in And the logic is far simpler than many of the excellent questions you've all been trained.
Well, we can have a debate.
And not with you, anybody can have a debate about anything.
So I'm not that convinced because what I'm not convinced about is just the financial part, and I'm a finance professor. So we used to teach for many years about executive stock options and employee stock options, and we would say all kinds of versions. We talked about the accounting, and we talked about value, the cost to the company, and the value to the employee, especially low-level employee. Now, the thing I like the most here is the HR part. So the HR part is fine, and I'm not an HR person, but actually my husband is, so I talk to him about that. And motivating it, getting engagement, reducing the accident rate, all these things are awesome, and then they translate. So that's all fine. The risk part is what I'm not sure about. The vesting part is what I'm not sure about. I'm just not sure about your proposition that it's a 2.5% that motivates them, that's going to get them going. It's the HR piece, it's the engagement, it's giving them autonomy, it's giving them respect, and we just had a union discussion a couple of times here. So it's about that part that made sense and made business sense. The equity part, I'm less convinced about.
So what you're saying is I should keep the equity and just give them the respect?
No. Keep on saying, just a second, I want to say one thing, and we'll continue it later. You were saying, I can't pay them more, but you were saying I can give them more equity. Now, the equity comes from somewhere. I mean, there's a conservation, right, agree. So it comes from somewhere. So you're telling me they're getting $70,000, well, that $70,000 would have gone someplace else. So are you telling me that your executives are paid less? I mean, what are you saying, actually? Because they're being paid more, so the pie gets larger, and then it's a question of how to divide it. So we can keep going under this.
So I'd say a couple things. One, I do think the least important part of getting the business results is stock. So I believe I actually think that is the least important part of it.
Not about finance.
Okay, so that's what I believe.
If they don't have stock, if they don't invest in anything else, then they need about debt and other things. So they definitely agree that financial literacy is important. Yeah. But about investment, they first need to have money to invest.
Well, they don't invest, right? This is free.
You gave them your stocks. Anyway.
But yeah, look, and I'm not saying we have all the answers. In our models, on a percentage basis, well, in terms of your question of where did it come from, and put aside, how much of this was the stock versus the HR stuff, because we'll never know. It's unmeasurable. This is like, I'm trying to explain how ridiculous of an outcome this is. Like, to get a garage door company to 36% EBITDA margins, it's not, no one would say that's possible. Or another example of these 12 experiments. We've exited 6. We have 3 on the horizon to exit. Of those 9, the returns are going to be, the worst we've ever done is 3 times our money, which is a top 5th of every private equity deal that's done. Just hold on one sec. And they've ranged from 3 to 10 times. So on your calculator, look at what $10,000 is, multiplied triples 10 times, or 9 times, which is what we're going to have. And some of those were 10x deals. So $10,000 would be $1 billion, basically. That's how hard this is. It's when we talk to our investors, it's like unbelievable. I mean, in the history of private equity, we've never seen these results. Why can't we give the workers some of that? Why do we have to have private equity firms saying 15% equity plans and it's all for the people at the top? We massively overinvest in senior people in this country.
Thank you, Pete, for being here.